So you're finally thinking about investing. But then you hear stuff like mutual funds, index funds, ETFs, hedge funds, and it feels like everyone's speaking some secret Wall Street code, right? No stress. You don't need to know it all to get started. I'm going to break this down super simple. We're talking about investment funds, what they are, why they're a big deal, and which ones might work for you. So, what exactly is an investment fund? Okay, imagine you and your buddies are at a restaurant. Instead of everyone ordering their own food, you all toss some cash into the middle of the table and tell the chef, "Yo, make us something awesome." The chef grabs your money and comes back with this epic platter. Some wings, a little pizza, maybe some tacos. You all share it and everyone gets a taste of everything. That's basically what an investment fund is. You and a bunch of other people pool your money together, and a pro, called a fund manager, takes that cash and buys a mix of investments like stocks, bonds, or even real estate. You don't have to pick each investment yourself. You just buy into the fund and boom, you own a tiny piece of everything on that platter. Why is this cool? Two big reasons. One, spreads the risk. Your money's not all in one stock, so if one company tanks, you're not totally screwed. Two, someone else does the work. The fund manager handles the research and decisions, so you don't need to be a stock market wizard. Now let's break down the four main types of funds so you can see which one fits your vibe. 1. Mutual funds. Think of mutual funds like a group project where one person's doing all the heavy lifting. You and a bunch of other investors pool your money, and a fund manager picks what to invest in. Stocks, bonds, whatever. They decide when to buy, when to sell, and you just chill, owning a slice of the whole deal. Here's the catch. You can only buy or sell mutual funds once a day. So if you're like, I want to buy at noon, you're waiting till the end of the day to get your price. Are they good? Totally. Mutual funds are super common in stuff like 401ks or retirement accounts. They're great if you want someone else to handle the decisions. But here's the thing, fees. Mutual funds charge something called an expense ratio, which is like a yearly fee for managing your money. Some are low, like 0.5%, but others can hit 1% or more. That might sound small, but over 20 years it adds up. For example, a 1% fee on $10,000 could eat up thousands in growth over time. So, always check the fees. 2. Index funds. Index funds are for people who don't want to play the beat the market game, they just want to go along for the ride. Imagine there's a list of the 500 biggest companies in the US, called the S&P 500. An index fund just buys all of those companies. No guessing, no overthinking. It's like copying the answers from the smartest kid in class because you know they're probably right. Since there's no fund manager constantly tweaking things, index funds are dirt cheap. We're talking fees as low as 0.05% or less. Compare that to mutual funds, and it's a steal. The trade-off? Index funds don't try to outsmart the market. If the market's up, you're up. If it's down, you're down too. But here's the kicker. Over time, the market usually goes up, and index funds often beat the smart folks trying to time the market. Crazy, right? For example, a 2025 study showed that 65% of actively managed funds did worse than the S&P 500 last year. So index funds are like the tortoise in the race. Slow and steady, but they usually win. 3. ETFs. ETFs, or exchange-traded funds, are like index funds' cooler, more flexible cousin. With mutual funds, you're stuck waiting till the end of the day to trade. ETFs? You can buy or sell them anytime the market's open, just like a stock. It's like choosing between a set dinner menu, mutual funds, and a buffet, ETFs. Most ETFs track an index like the S&P 500, but there are also ETFs for specific stuff. Tech companies, clean energy, even wild stuff like meme stocks. And just like index funds, they're super cheap with fees often under 0.1%. The downside? You need a brokerage account to buy ETFs, and if you're trading a lot, you could rack up fees or taxes. Plus, since prices move all day, the value might feel a bit like a roller coaster. 4. Hedge funds. All right, hedge funds are like the private jet of investing. Not for most of us. They're for the super rich, and you often need to be worth over $1 million, not counting your house, to even get in. Why? They're high risk, using crazy strategies like borrowing money to invest more or betting on companies to fail. Their goal is big wins, even when the market's crashing. But here's the deal. They're expensive, like really expensive. Most charge 2 and 20, 2% of your money every year plus 20% of any profits. So if you invest $1 million and you make $200,000, they're taking $40,000 off the top. Oh, and your money might be locked in for a year or more, so you can't just pull it out if you change your mind. Quick recap. Mutual funds are like having a driver. You just sit back, but you can't hop out whenever. Index funds are like a train. Cheap, steady, and follows the market's path. ETFs are like a rental car. You've got control, but you're still on the same roads. Hedge funds? That's a private jet. Fancy pricey and not for regular folks like us. So what do you think? If you had to pick one fund to start with, which one's calling your name? Drop it in the comments and let's keep the convo going.